Good afternoon and welcome to the December 5th, 2025 Retirement Benefit Trust of St. Mary's County, otherwise known as OPEB meeting. And this is the call to order. My name is David Weiskopf, County Administrator and Chairperson of this board. We'll start as we always do with introductions. To my far left,
Vanetta Van Cleve, Chief Financial Officer for the county.
John Walters, Citizen Representative.
Scott Ostro, County Commissioner, District 4.
Catherine Pratson, Director of Human Resources.
Joy Sapp, Deputy Director of Finance and Plan Administrator.
Dana DiGregorio, Administrative Recorder.
thank you, everybody. And has everybody had the opportunity to review and look at the agenda for today? And if so, I will entertain a motion.
Move to accept the agenda as presented.
Second.
I have a first and a second. All in favor signify by saying aye. Aye. Ayes have it. Motion carries. Next up is the approval of the October 24th meeting minutes.
I move to approve the October 24th meeting minutes as presented.
Second.
I have a first and a second. All those in favor signify by saying aye.
Aye.
Ayes have it.
Abstain.
Motion carries. At one abstention. Absolutely. Takes us right along to the presentation by Mr. Wing, the Q3 Investment Performance Report. This, sure. Okay.
Yeah, I'm working.
Does Andrew need to come out and take a look, or?
It's board, it's email, I don't know.
Oh, gotcha. Okay.
And we have the printed
Yeah,
documents.
we have the printed documents. It's be tougher for those at home to follow along, but we will muddle through. Thank you, sir.
Of course, well, I'll just have to provide much greater detail.
That's right.
Make more comments. No, so with that said, if you want to jump behind Exhibit 2 for everybody who has a hard copy here, we'll start. A couple quick comments. From an economic perspective before we get into markets, so we'll start on page 10 here. And just quickly from an economic perspective, if you look at the top left bullet point, do note that the economy appears to have decelerated a bit in Q3 and still using economists' forecasts now because we don't have the Q3 GDP data that won't be released until after. That's just not the right. That's good. We're good.
It's September 30.
Yeah, we're good.
Oh, it says September, for September
4
30th.
September.
Right.
All good. All good. All good. All right. So as I was noting, actually, you can draw your attention to the top right chart showing quarterly real GDP growth. The first stripe bar there in Q3 shows economist estimates for 2.5%. As I noted, we won't get the actual data for a couple weeks now. And looks like a mild drop off from Q2, but recall Q1, Q2 heavily distorted by trade. So a cleaner version of what happened in the first half of the year is probably averaging Q1 and Q2. That would have been about 1.5%, 1.6%. So probably, a decent number in Q3 here coming, which recent estimates have shown to be a little north of 3%. And what's been interesting, over the past 8-9 months, in the wake of, some uncertainty earlier this year and talk of possible recession, has been the resiliency of the economy, largely attributable to spending coming out of the tech sector, and notably capital expenditures for the AI infrastructure build out. If you look at that bottom chart, that illustrates that to some degree, where we're showing year-over-year economic growth and the contribution to that growth. So the blue part of that sand chart is the contribution coming from this AI spending, and the black is the rest of the economy. So clearly the economy has decelerated, but a lot of this spending has softened the deceleration and is likely set to continue to grow into next year. That I'll circle back to later. Page 11, quickly, we talked about a second ago, growth has been pretty good in Q3. Consumer spending was strong. A lot of spending coming from the corporate private sector and technology companies on the build out. And now we're set to get a boost from the fiscal side. If you look at the top right chart, it shows the impact of the reconciliation bill earlier this year And the biggest positive impact is set to come next year in 2026. And you can see it trails off and then goes negative. That's largely because tax cuts and credits are front-loaded and spending cuts back-loaded. So we have these dynamics now where the private sector seems reasonable. We're going to get a fiscal boost. Financial conditions are pretty loose, and the Fed's cutting rates again. So they've cut twice over the past few months, very likely to cut again at their next meeting in less than a week's time. It ends next Wednesday. It appears that they're definitely erring on the side of caution for the labor market over inflation. The labor market has weakened. It almost seems like we're in this sort of stasis right now where it's kind of a no hire, no fire sort of a economy, and they're wanting to cut rates again, trying to kickstart labor demand at a time when the inflation question is still a little bit open, as noted in the bottom chart to the right there, where we're simply showing a black line, which is a measure or a survey of what services firms are paying for basically their input costs versus inflation there in blue. And you can see all the way to the right that prices paid. Part of the surveys ticked up rather notably, and if history was any prologue here, we would expect inflation there in lighter blue to continue to remain above the Fed's 2% target and maybe even tick a little bit higher here in the coming quarters. So that's an open question as we head into 26, something we're keeping an eye on. But remember, this is sort of a post through Q3 discussion. If we jump to page 13, then just look what happened in markets in Q3. They did quite well based on the fact that economic activity was a little better than expected. So we have equity markets in the first three rows there. You can see pretty strong returns, a little bit lower than we saw in Q2, but still well above average. So U.S. equities, developed non-U.S. EM up between 5 and 10%, with the U.S. roughly in the middle there. We have U.S. bonds, fourth row down, up 2% as well, so a nice gain from bonds. And then as far as the other asset classes within the trust, TIPS 4 up from the bottom, also posting a nice gain. And then as we'll see later on, IFM, the infrastructure manager, also up 2%. So all the asset classes the trust had exposure to doing quite nicely. We go to page 14. I want to make a couple quick comments here around the Q3 performance when we look underneath the hood, and then talk a little bit more about the outlook as we wrap up on 15. But really the pattern continued that I've belabored at this point over the past couple of years now, specifically that, sort of those mega cap related firms, AI names, but particularly those in the smaller part of the market as well are tending to do good and drive things when the market goes higher, and vice versa when it has a little bit of weakness, as we saw in Q1, and then more recently a couple weeks in the first half in November. But to illustrate that, if you look up top in the sector returns, the sectors that did the best: communication services, consumer discretionary. So there's your Metas, your Alphabets, and your Amazons, your Teslas, respectively. And then 4 up from the bottom, information technology. Best performer, NVIDIA, Apple, Microsoft, all embedded in that. But the interesting dynamic here is only 3 of 11 sectors outperform the broad market, right? So what that means is that the sectors that did the best are the largest, comprised of the largest stocks, those mega cap type names. But what was also interesting, if you look at the bottom chart, was what took place within, again, the sort of the smaller company part of the stock market. Here we're showing the Russell 2000 index of small caps, how the stocks of unprofitable companies did there in blue versus their profitable company counterpart stocks. And you can see a massive spread in that performance, just measuring the growth of $100. So in other words, the stocks of unprofitable companies outperformed the profitable company stock counterparts by almost 13 percentage points. And if you dig deeper into that, various anecdotes of cohorts of baskets of like drone makers, quantum computing, crypto sensitive in the quarter, really driving things and driving it pretty strongly since the market made a low in April. A lot of these names up 100 to 200+% through the end of September. Although, like I noted, in early November, a lot of those names got hit pretty hard. So that pattern is continuing. And then finally, to wrap up on 15 here, circle back to my economic comments. As I noted earlier, that tech spending is set to continue next year. If you look at the top right chart here, this is showing for those Magnificent Seven stocks, their capital expenditures and R&D over the past handful of calendar years, and estimates for next year all the way to the right. Now, importantly, that estimate of 17% was prior to their more recent earnings call. Based on their revised guidance for spending and investment, it's now estimated that it will grow by another 30%. So they are spending on this build out, and it's being rewarded by investors. Sort of a build first, justify later mindset. And what's interesting as we think about all of what may happen going forward within the context of what happened over the past couple of years, eventually we're going to get to a phase where investors and the market's going to ask, what is the return going to be on this investment? We're not there yet. Companies are still being celebrated for, saying they're going to spend more, but it has become a little bit more discerning. So it's not just we're spending more. It's, well, is this credible, right? What's your adoption going to be? What's your build out going to be? So we're getting there, but we're not quite there yet. The other interesting dynamic, if you look at the bottom of 15, where we're showing at the title capital expenditures as a percentage of EBITDA, which is just a proxy for cash flow. The 5 blue bars to the left are companies, their current metrics, and then 2 to the right are sort of the poster childs for previous investment booms. AT&T with the fiber build out for the internet late 90s, and then Exxon with the shale boom in mid 2010s. So if we look to the left, what this is showing is for a handful of these companies, notably say Amazon, Meta, Oracle, they're almost spending as much as their free cash flow is. So at some point, if you're going to continue to ramp up spending by another exorbitant amount next year, you're going to have to learn or find a way to free up capital to spend that, right? So you can do things that generally are not taken kindly to, like cut your dividend, cut back on buybacks, or issue equity. But usually what occurs and exactly what we've seen is that you issue debt, right? So you go to the debt markets, and those 3 companies have done just that and issued a lot of debt over the past couple of months, which is multiples of what we've seen in any given calendar year over the past few years. And as far as this dynamic is concerned moving forward here, you think about it from a historical perspective and a competition perspective. And, previous innovations, whether it be railroads, electricity, the internet build out, who ultimately benefited from that was businesses that utilize the innovation and consumers themselves, because they're largely commodities, right? And if you think about, AI, it's largely a commodity, right? It's obviously an innovation, but you have certain firms competing and doing it, and a lot of the benchmarking and what it can do is broadly the same. So history would argue that the return on the investment probably isn't going to be what the market expects. And then from a competition perspective, I've talked about the China issue before, and any market they tend to enter, profits disappear just based on the way they operate of flooding the market with basically cheap goods and technology to gain market share. And then the other interesting dynamic, if you think about these Magnificent Seven stocks, why they've done so well over the past few years, is they kind of operated in their own niche industry, doing different things, where now they're all competing with one another in this dynamic. And again, competition just tends to breed, lower prices for the eventual end consumers, which means lower profits for them. So again, the long-winded way of saying, right now the market doesn't care, and it won't care until it does. But the timing of that's wildly uncertain. But we do think the ultimate return on this investment is going to underwhelm compared to the valuations that these companies are trading at these days, which embed investor expectations that the return on the investment is going to be quite high. So with all that said, I know it's a little lengthier overview. We'll walk through the book a little bit more quickly than normal to catch us back up on time. But any questions or comments before we jump into the trust? Okay. So if you all please flip over the next exhibit. You can skip 22. I'll cover that as I walk through the metrics. We can just go right to 23 and just look at some high-level numbers here. So the summary of cash flows up top, all the way to the left, the QTD quarter to date, 129.1 million we began at. You'll note the net cash flow was very modest. It was just the reimbursement was processed after the quarter end. So the Q1 fiscal 26 reimbursement was processed, and it's just not prior to the end of September, so it looks a little different than normal. So that plus the net investment change left us at about $5.4 million higher. If we look from a return perspective at all the way to the left in the middle of the table, up 4.2%, modestly behind the policy index, that largely coming from some of the active equity managers that I'll highlight a little later on. Also wanted to note, we did have the final numbers from a fiscal year perspective now that we got all the private markets, and that came in about 11.5%, so 5 percentage points above the actuarial assumed rate of return. But as we spoke about earlier this morning to some degree in the previous meeting, that even though we've been making more than the assumed rate of return over the past few years, with the absence of the contribution, the funded ratio is stayed high, it's just inched down a little bit absent that, whereas, somewhat counterintuitive when obviously the returns have been better than that assumption itself. If we want to go to the next page quickly, I'll just hit a couple more here. Despite those comments, if you look on 24, usually don't hit this page, but worth noting that the trust is at a high water mark at the end of September, despite those net cash outflows that you see in the black line. So obviously it's below zero, meaning that cash has been coming out, and it's been around 3 to 4% of the trust value over the past few years, which isn't exorbitantly high, but obviously makes it important from a risk perspective to make sure we have liquidity so that we don't have to sell things at the wrong time when we need it. And obviously that lower assumed rate of return allows us to be a little bit more conservative on the investment side. Obviously, we're not where we need to be because of the legacy private markets, but they continue to draw down and are now only about 18% of the trust compared to a few years ago when we were pushing upwards of 30. So slowly but surely, we're getting a little bit more liquid over time. And just to highlight that further, if we go to page 25, we look at the net cash flow column. Like I spoke about yesterday, a lot of numbers there in the top half. Remember, that was in the wake of all of our discussion around U.S. equities and valuations and historical returns and risk and how to potentially change the structure. So a lot of changes that were approved and executed earlier this year. The things that I did want to highlight really begin in the middle of the page there, where you see that negative 75,000. So that's the first either call or distribution from the legacy private markets managers on this page. Recall, if it's a negative number like it is there, it means that's a distribution out of the investment back to the trust, and vice versa. You can see for the next number, it's positive 39. Now, when you sum up those three numbers, starting with negative 75, and then go to the next page and sum up every single number in that net cash flow column, going down to the latter third of 60, positive 66, 388. On balance, we only got it back about $114,000 from the legacy managers, which is lower than it's been over the past couple of quarters. I think, like I mentioned earlier, this fiscal year, we'll say, is that the market dynamics have actually changed in favor of being more beneficial for these types of investments. They're highly dependent on the IPO market to exit some of their positions, mergers and activities to exit some of their positions, kind of just broad liquidity dynamics, broad investor sentiment, which has improved notably because it became really problematic, kind of post-COVID and then over the 22 bear market. And in the wake of that, even though the equity markets were doing well in 23, 24, those dynamics hadn't really improved until this year. So it's a little underwhelming, to be frank about it, that we only got back about 114. But at the same time, money continues to come back. It will continue to wind down. I was just hopeful that that number would be a little bit higher and accelerate that process, given the broad positive environment for that to happen. Outside of that, below that 66, the $300 and change, you could see some positive numbers there, in addition to some of the U.S. equity restructuring and rebalancing. We did some rebalancing back into fixed income as well and into cash for future reimbursement needs. So with all that said, if you want to jump, let's go all the way to page 35, please, and we'll look at some of the underlying investments here to wrap up on the traditional assets, and then we'll take a look at the private market numbers as well. But so on page 35, if you go to the second blue row there, U.S. equity composite weighted average of the underlying managers, eerily similar to the number we spoke to yesterday afternoon, about 50 basis points behind the broad U.S. equity market. Now, importantly, not a lot of data. You see a lot of dashed lines on that page. It's because we don't show the full history of every single fund. We show that, when the board's going to make a decision, but we only want to show what the trust's actual experience has been. So the first two lines there, both index funds with Schwab and Vanguard, both in line with their respective indices across every single period, as we would suspect. What drove the modest underperformance was really twofold. You see JP Morgan in the middle of the page there, the active large growth manager, just being underweight those Mag 7 stocks. So what's interesting, if you look at the return of 9.3% versus 10.5 for the benchmark, and then the rank of almost top quartile. So they're behind by a percentage point, but still ranked in the top quartile, again, indicative of when those largest stocks do the best, difficult for active managers. The other component, if we look down to the bottom, the John Hancock small cap, excuse me, dynamic growth, recall that was the fund, the new fund where the previous John Hancock rolled into and then was replaced at a subsequent meeting. But again, an interesting anecdote. If you look at the 1 month they were in the trust all the way to the right there where you see the 3442, they were a percentage point behind their benchmark, but top quartile. So what's going on there? Well, it's all that unprofitable stock outperformance that I showed earlier in the small cap space. Active managers are usually underweight those sorts of shares, right? So difficult to keep pace in an environment where, you know, the junk, if you will, is ripping higher. Next page, as we walk through some of the other asset classes, non-U.S. equity, composite, you know, similar dynamics within the U.S. You can see composite up 4.4 versus 4.8. Dodge & Cox, our value manager, about 40 basis points behind the benchmark, but again, a ranking of top quartile. So some of the dynamics inside the U.S. obviously also apparent outside the U.S., making it more of a difficult environment for active managers. And then WCM, below the index fund, up 1%, about 500 basis points or so behind their respective benchmark. They're more of a higher quality manager. So in an environment where lower quality is outperforming, that's going to be a headwind for them. And that was largely the case during the quarter. Their intermediate and longer term numbers still remain, you know, extremely strong. So we have no concerns about that, even though the magnitude of the underperformance is a little more than obviously we would typically like to see. In emerging markets down below, you can see up 10%, modestly behind the broad market. Again, that largely coming from DFA, 2 rows down. Again, China, as I believe I noted earlier, has been a big outperformer lately, particularly their large mega cap tech stocks. So that's been a headwind for a lot of managers in that space, particularly for DFA. If you recall, they tend to have a tilt towards smaller cap stocks. With those stocks lagging a little bit, it was a drag for them. And then finally on 37, on the flip side, as I noted earlier, infrastructure, IFM up 2%, continue to kind of generate those 2.5% type returns in most quarters ahead of their benchmark, that inflation plus a premium. Tips up a little bit north of 2% in line, and then fixed income up 2.2%. We saw both active managers, Loomis and Reams, do quite well relative basis, and then Lord Abbett broadly in line, but offsetting the outperformance from some of the 2 managers above because they have less rate sensitivity, right? Just in the 1 to 3 year space. So not as much of a kicker, if you will, when rates come down. But on the flip side of that, when rates move up, then we get some protection from it. So with that said, just quickly, if you want to jump to 39, we'll revisit how the private markets are shaking out here. Not too much to speak of, I would say, as we think about, you know, some of the what may come down the pike here. If you look at the unfunded commitment column, kind of fourth from the left, I guess, second under the commitment header there. Recall a lot of the stuff earlier on, like those earlier Stepstone funds, are not going to call any more capital. So as you go from top to bottom here, all the way at the bottom, that $2 million in unfunded commitment is in theory what could potentially be called, but we don't expect that to be called. You know, a lot of times managers will call basically like 90% of your initial commitment. Now some will call the whole thing, but again, a lot of that those outstanding dollars are for funds that are very old. And then all the way to the right in that bottom page, or excuse me, the bottom row, where you see the 16.5, that's the IRR, right, the internal rate of return. So not exactly like the return on the previous pages, because this one is dollar weighted. Since the managers have discretion when to ask for money and when to send it back, it means when they have more money, that's given a bigger weighting than in other periods. So at a high level, 16.5 is a good number, right? You want kind of a public equity return plus a premium, which is there. But as we talked about before, it's kind of, since post-COVID, come down quite a bit. I remember at one point it was north of 25, right? So it's come down a little bit and come down to 16.5 versus 16.7. So the program has worked extremely well over the long term. It's just been more recently as the dynamics have changed for these types of investments that we haven't seen much of any benefit over the last few years. But again, over the long term, it's certainly been a success. It's just been challenged more recently. Page 40 quickly, as I'll wrap up with private debt and real estate. If you look at that unfunded commitment column, again, that is wildly overstated. The first two funds have already been liquidated, those Golub funds, so they're not going to call anything else. And I've talked with the Ironsides guys, the last two funds, they have little intention to call any of that remaining unfunded commitments. So this as a percentage of the total pool is de minimis now. It's about 0.5% of the trust. But if you look all the way to the right in that bottom column with the IRR at 10, exactly in line with what we want to see, because remember, this is debt, not equity. So with this private debt, you would essentially want a premium over public debt and in line with public equities, right, which is about 10. So that this has also worked well. And then finally, with real estate on 41, if we look at the unfunded commitment again, around 740-ish, the bulk of that is that Elm Tree fund. Remember, that's gone, right? So you see the valuation further to the right. They had presented opportunities for investors, remember, to sell the interest in it, and this is maybe a year ago at this point. So the unfunded commitment, again, is woefully under what the summation shows there. And again, all the way to the right, the IRR about 10.3%, probably on the lower end of what we would hope for, but still we would consider it a reasonably successful program. Like, you're not looking for a private equity type of return from private real estate, but probably incrementally higher than public equities. So not the same type of premium, but maybe 1% higher, which is probably more in the neighborhood of 11-ish type of percent. So, broadly in line. So as we wrap up all these dynamics, right, say, good start to the fiscal year, some challenges from a relative equity and perspective given the environment, but private markets continue to wind down, still comprise around 18% of the trust, but we'll get there, and at some point next year it probably makes sense to do a similar exercise that we did for the SORP, specifically to say, these are going to come down to where do we want those ultimate funds to go. So I think that'd be a prudent exercise, probably to begin in, say, like April. It's when we have our kind of off quarterly meeting, and then if we continue it later that year, because it's not something that we need to decide immediately, because it's going to take a while for it to wind down. But that'll be a good project for the next calendar year. So with all that said, I will pause there, see if there are any questions or comments as it relates to the report.
Yeah.
I don't have anything. Very thorough report.
I move to accept the Q3 investment performance report as presented.
Second.
I have a first and a second. All those in favor signify by saying aye. Aye. Ayes have it. Motion carries. Next up,
The magic page.
Yes, sir.
recommendations.
Yep. So there are a couple quick things to note. Total assets, that column third from the left there, you can see about $134.8 million. So it was only about $300,000 higher than at the end of the quarter. But remember, we had the disbursement. So the net investment gain was of the underlying assets a little north of $1.5 million. So what we're proposing here is effectively we don't know what the current quarter distribution or reimbursement will be, but we're just assuming it's been broadly in line with what we've seen over the past 3 or 4 quarters, which is the number you see at the total rebalancing column of -$1.25 million. So what we're proposing how to fund that is Two modest redemptions from equity markets. You can see 500,000 and 250,000 from the Vanguard Russell 1000 Index Fund and Dodge and Cox International Fund, respectively. If you go further down the page and skip over the 500 grand there for a second, also sourcing some of that from cash because we still have a decent chunk of that. So the sales in aggregate and the use of cash are about 1.75. We're recommending using $500,000 of that to reinvest back into fixed income, which in turn to the right, if you look at the post-rebalancing allocations on the bottom table there, will leave us, reasonably close to targets. We'll still be notably underweight fixed income, but that's offset modestly from cash there. And the cash level that would be left at about $3.1 million would still leave us with 2 more quarters of reimbursements covered. And then hopefully as the private markets money continues to come back, once we get to the third quarter, that'll be covered too with money that's been returned and the remaining cash we have, absent any other changes. So I think in theory, we probably have about 3/4 of reimbursements covered, not including any changes to the contribution policy that may come in fiscal 27, right?
Correct.
Right. So I would say that for the current fiscal year, we should be largely covered, and then we can have the discussion around how that may change, later in the fiscal year. So with all that said, I'll pause once more for any questions or comments.
I recommend the board approve the proposed rebalancing as shown on page 1 and summarized on page 2.
Second.
I have a first and a second. All those in favor signify by saying aye. Aye. Ayes have it. Motion carries. Thank you, sir. Good job.
Well done.
The plan administrator, right? Is that where we are?
Okay, so good morning. Since the last meeting, we had one capital call in the amount of $46,049.51. Administratively, we've paid out $2,400 to Boomershine, and we've had 1 quarter of reimbursement so far at $1.2 million. The next quarterly reimbursement for the healthcare cost will be made at the end of December after we have the final December invoice. And the first meeting for fiscal year 2026 will be February 27th.
Okay, thank you.
I move to accept the plan administrator report as presented.
Second.
I have a first and a second. All those in favor signify by saying aye. Aye. Ayes have it. Motion carries. One last one.
I move to adjourn.
Second.
I have a first and a second. All those in favor signify by saying aye. Aye. Ayes have it. Meeting adjourned.
Okay.